Hello, you're listening to Ready, Set, Go Real Estate Investing Podcast, presented by Brandon Elliott. This show will be going over all aspects of real estate investing and is intended to educate, motivate, and prepare you to take action on your first or next real estate investment. For more information, please visit BrandonElliottInvestments.com. Thank you for listening and enjoy.
Welcome back, everyone, to Ready, Set, Go Real Estate Investing Podcast. I'm your host, Mr. Brandon Elliott. We got somebody that started off W-2 engineer in 2009. Some good timing of jumping into real estate. Started off with single family houses, flipping as well up to 2015, and then started focusing on some bigger apartment buildings, also new development, commercial, and at this point, 10,000 plus doors, living over in Hawaii, wrote a book on wealth elevator, correct?
Yeah.
And yeah, excited to just hear about your journey, how you jumped into real estate like this and rode this massive wave, and kind of just getting your opinion on the market where we're currently at for the overall everyday, investors, but also commercial space. So Lane, what's happening, man? How we doing today?
Yeah, aloha everybody. Thanks for having me.
Yeah, appreciate you jumping on today. So anybody out there that doesn't know who you are, where you're from, what you're up to, do you mind just giving that 30,000 foot view for the listeners?
Yeah, today we syndicate apartment buildings and we develop new workforce housing apartment buildings. And we're also kind of drifting off to venture capital, non-real estate investments these days to kind of round out the portfolio. But cool. $2 billion of assets owned. But didn't always start off that way. I graduated with an engineering degree back in 2007, saved my money up to buy a little single family home to live in Seattle back in 2009. Because I was traveling all over for work and I was never home, I just decided to rent it out in my 20s. And I was like, holy shoot, I better do this again and again. And at that point, I feverishly saved all my money and bought 11 rentals by 2015. I was hooked on this stuff, right?
Wow. So you totally missed the crash and were smart with your money back then and jumped in at a good time, right? When everything's at the very lowest, right? And then started kind of working your way up, correct?
Yeah. And I think even more importantly, like for me, like being a W-2 engineer and having a good salary, like I was established in my job for a couple of years, then shit got real bad.
Yeah.
And I was able to hold my job during that time. And like people always ask like, oh, shouldn't have been an engineer. I'm like, well, that was a big part of me being able to save. Like some years in the beginning, I put like $100,000 to buying more rental properties down payments from 2009 to 2015.
Wow.
So that's, I didn't really like flip them to the truest extent back then. I was just mainly a passive investor, just putting boring old down payments on turnkey rentals was how I originally started.
Yeah.
But, I think, today I try and create content set for more accredited investors, guys with, good jobs that are a bit too busy to flip houses or wholesale houses, which I just don't think that there's too much content out there for that particular avatar.
What's awesome that I do really love here is that I think it really highlights timing in a big way, but also having a foundation of stability. Like you had a good paying job, you had as a young man having good paying job, good location, but the job kind of having you travel a bunch, it kind of forces you to rent it out, right? Which is good if you're smart. Not everybody would be. And then I'm sure there was mistakes along the way, but timing really takes care of it because, it's just going up and up and up from there. So it's good timing. Did you have any friends, family? Like why real estate for you? Like what inspired you and how did you kind of miss the year or two before when it was really crazy?
Yeah, no family doing this stuff. When I was a kid, my parents said, yeah, like, you want to own your house. You don't want tenants. They'll mess up your property.
Yeah.
So, I always tell people I didn't have any accredited investor friends or uncles. Nobody in my family did this stuff. They were just taught to go to school, get a master's degree and, rock out on that with 40 years.
Yeah.
But yeah, kind of to your other question, I think very early on, I invested in like a lot of stocks and I would watch Fast Money and I would like do these swing trades. And I got my ass handed to me in 2008 when all that, the stock market was crashing back then.
Yeah,
so like I didn't have very much money built up at the time, maybe like 20, 30 grand, right?
Sure.
That I was able to save in my first year or two working. That was a lot of money to me, right?
Yeah,
It still hurt.
that's a lot. Yeah.
But that kind of set me on a trajectory of like, this traditional investment sucks. This is not real stuff. And, now like, real estate, it was just good timing, like I said. And I think right now is like, it is no different than 2010, 2012, as far as I can see today.
Really? Okay. Well, let's talk about it, because at the end of the day, we've been on this cycle going up and up and up for such a long time now. And I think we got spoiled for a very long time with interest rates being very low, historically the extreme lowest. And then just the last year and a half or so, 2 years, I guess, interest rates dropped tremendously. And it was kind of, or sorry, not dropped, went up and kind of made a mess in the commercial space a little bit, right? Nobody was really betting on it or expecting it. So what did you see in the market for other people that weren't really expecting the high, spikes with the interest rates? And where do you think we are currently?
Yeah, I mean, real estate is very much tied to interest rates.
Yeah.
And what we saw is 40-year high in interest rates, quickest time in history that it's gone up this quickly. So obviously that has taken the buyers out of the market. So we're a buyer, right? We buy apartments too. 2 years ago, a year and a half ago, the prices were still high and the interest rates almost doubled, and which created the PITI, the holding costs got a lot more. And so the deals didn't pencil. Like, we have kind of a threshold that, we plug into our analyzer and that we want to hit, but when our debt service doubles on us, sometimes even triple on us,
what are you going to do?
What are you going to do? You can only pay a certain price, right?
Yeah.
And then so the alignment isn't there for the longest
You can't go into
times.
negatives. You can't go into negatives.
Yeah, like I'm not going to go into a deal, even if I know I can value add a project, if like my holding cost is going to keep me in the red for a long period of time.
Yeah.
We're not an investor that invests in like primary markets like California, Hawaii, just gambling on appreciation.
Yeah.
We're more in the red states, in the Sunbelt states, as we were kind of talking earlier. But yeah, like since then, these last 18 months, the prices have severely dropped. Nationally, across the country, I think it's safe to say 15 to 20% off the highs. But we all know it's on a market to market situation here. So places like Phoenix is probably one of the hardest hit, 35% drop from the peak. Houston, maybe almost as much, 30%. We're in other markets like Huntsville. Like Huntsville has got a lot of strong dynamics, not a lot of supply going in there in comparison to other markets, but still it's dropped.
Yep.
10, 20% easily. So right now, I mean, but it's not like the long-term dynamics have changed. And I'm sure you guys have beaten to death this type of stuff, right? Demographics, cost of housing, people need a place to live, blah, 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 blah. But right now, looking from my point of view, up until this point, the deals didn't make sense for me to go into because the basis was just too damn high based on what the affordability or what the debt service was. Now we're kind of finally reaching that equilibrium, and which is why you're starting to see the big players come off the sidelines. Just go and Google what the big guys are doing. Blackstone, right? Like they've come off the sidelines and started to come in here. So I look at them as kind of the pros in the market who have probably like the biggest pockets to be the early adopters. So, we've been kind of starting to underwrite deals and kind of get after it. And, I think this is that time. This is the bounce off the bottom. I would throw out another resource out there, independent source, ITR Economics. They have kind of the sine curve of where the market cycles are. They've already labeled it and proclaimed that commercial real estate has bounced off the bottom at this point. But I think there's a competing narrative out there that I'll point out. If you look at like Wall Street Journal or The Real Deal or, pretty much all industry newsletters, they'll say that there's complete turmoil in commercial real estate. And that's completely right, because a lot of these deals that were entered in with floating debt, deals that you needed to renew in 1 to 3 years or less, your freaking property is worth 30% less than what you bought for. There's, even if you value add the heck out of that property, you're not going to overcome that 30% drop. So you're going to be forced to sell, foreclose, deed in lieu, whatever at that point, which is why a lot of these deals are kind of being exited now in a distressed situation. And that's what people fixate on. But in reality, that was a telltale from 18 months, 2 years ago. We knew that was going to happen. It just finally happened. So it's kind of like these hot air balloons, like, all these hot air balloons were in the air and all their motors, they all ran out of gas because some idiot forgot to fill them up for the whole way.
Yeah.
Nobody knew that they needed to be up in the air for that long, but they're all coming down and crashing to the ground now. But in reality, maybe now, maybe 3 months ago, maybe 3 months from now, right? It's like the perfect time to launch your hot air balloon up in there.
I like
right?
that.
But people can't differentiate between the headlines of things that were, coming down 2 years ago and what's now, right? Unless you're in the market.
Yeah. That's a good analogy. I like that. I'm going to use that in the future. That's a good one. So there's a lot of big players with a lot of money on the sideline, right? You mentioned BlackRock and so forth. There's other players with billions just sitting on the sideline, kind of waiting to jump in. And we've seen some of these guys start taking a little bit of action. But, just like you mentioned, there's certain markets that, in my market, for example, San Diego, it seems like it's switching up a little bit. The last quarter started to show a little bit more signs of more of a buyer's market. And so I'm just kind of curious with your take on interest rates and still kind of keeping people supply and demand, obviously, but overall people not necessarily jumping in yet. But you're mentioning your take on it is people are starting to jump in right now, correct?
Yeah, and I'll differentiate between commercial real estate, which I'm in. I can't really comment on residential real estate. I think that's what you're a little bit talking about there and on San Diego. Again, like just my outsider's perspective on that is like in residential real estate, you have a lot of people that are in these sweet, sub 5% loans, and they're kind of stuck there. They're not selling. Right. Because
everybody got incredible interest rates, right?
Right.
Yeah.
Right.
Everybody refinanced.
Right. They don't think like investors and, if they've paid it down, they've got lazy debt equity there that they have to redeploy. That's not how regular people think. And thus, people are going to stay in their homes. And at the end of the day, pricing is determined by supply and demand. So like I said, in commercial real estate, the demand dried up, right? Like I'm a buyer. I'm like, heck no, I don't want to buy anything right now. Not these prices, not these interest rates. And that was why the prices plummeted. In residential real estate, that if we look at the supply side and we look at the demand side, the demand is still there, right? People still want to buy houses, especially people are moving up in the world. They're moving out of their parents' basements and wanting to start a family or just live on their own. But the problem is that supply side is restricted, right? Because ain't nobody really want to sell their house.
Sure.
So I think that's what's keeping the prices kind of where they were at, which is a sign of I don't know if you call that healthy, depending on which side of the equation you're on. But that's not the case in commercial real estate, right? In commercial real estate, there's less of that. I think it's kind of dumb just to stay in your house because you have a good interest rate. If you have that thing paid off halfway, you should be redeploying that capital.
Yeah.
But that's not how, my parents think, right?
Yeah. Which is, it's just, it's different to think like the average versus an investor and how to actually put the money to work, capitalize off of it. When it comes down to interest rates right now, like what do you think the future kind of holds for us in the market? And then I do want to hear more about how you guys are picking up your leads currently.
Yeah. So as far as interest rates, I don't watch headlines. I just look at what the big players, the rate cap providers are saying out there. What I would suggest is bookmark the Chatham Financial Curve. They're a big cap rate insurance provider that we've used.
What is that again?
Chatham Financial Curve. You just Google that. Another one is the CMG. CME Group has this. It's not a graphical view that Chatham Financial has. It's more of this for some people who are like an engineer like me, I like numbers. So I like how they present the Vegas odds and where the interest rates will be. But right now, I just pulled it up. In September, they're calling it a over 90% chance that we're going to see at least a quarter point rate decrease at that point. And then you can kind of follow along on the tabs. If we follow it along till March of 2025, they're guessing that it's going to be maybe a full percent less than what it is today. Mm-hmm. So I don't listen to anything in the news. I don't listen, and especially don't listen to any people without $10 million net worth in their bank account. I follow what the people who skin in the game is, and nobody has more skin in the game than these rate cap insurance providers because they bet their ass their whole business on it.
Yep.
That said, they've been known to be wrong, right?
Yeah,
But
yeah.
That's
Nobody's got the
that's my
crystal. Yeah, nobody's got the crystal ball. But I love how you mentioned, if you don't have $10 million, for your net worth and so forth, then I'm not going to pay attention to you. I think a lot of people focus on guidance and attention from people, getting advice from people that really they shouldn't be getting advice from, right? We've all been there and done it, but any mistakes that you've made kind of first getting started in the real estate space that you've learned from and you're like, man, I wish somebody would have told me this that actually had the experience.
Yeah. So, first one, just to reiterate your point, I think in 2000, a few years after I bought my first rental property, somebody told me to get a 15-year mortgage instead of a 30-year mortgage and pay down your debt. Yeah. And I did that. I probably paid $5-10 grand and like a refinance origination fees. And on the one hand, I'm like, is this what I want to do? Or do I want to buy more properties? But again, like to your point, and as I say, you never take financial advice from people who aren't financially free or there. Yep. And as crudely as it sounds, your net worth determines your rank out here. Right? It's all net worth is, money's not everything, but as far as this goes, net worth is the score, right? Assuming that, you are not just a trust fund kid from your parents. Yeah. That's early on. That was a big, glaring mistake that I found. And I'll say this very carefully. And I'll say the wealthy focus on cash flow and net worth growth. The regular people, my parents included, and, they think that normal financial wisdom, what they focus is on interest rate and debt. They want to pay down their debt. And they're they're so concerned with the interest rate. For example, if you're somebody who's on their home loan for less than 5% and say, I don't want to get rid of this. Well, it's not as not as clear cut as that, as the straight interest rate. Like I said, if you've been paying down your mortgage and you have a lot of lazy debt equity, you might be able to take that money and go buy 3 houses, and then your cash flow and your net worth will be improving. So again, wealthy focus on your net worth growth and your cash flow. The poor people focus on debt and interest rate. Catch yourself. Yeah.
Also buying a lot of liabilities that are stupid, right? Like that.
Oh, yeah.
But besides the fancy, $20,000 Gucci sweatshirt or something, it's like when it's not needed. So I love that.
Yeah. I think, maybe that's a good segue to like my new book, The Wealth Elevator, it's kind of split up into floors. I think a lot of books out there, they're kind of written for broke guys who don't have more than, $500,000, $1 million net worth. They're like the Dave Ramsey. I like Dave Ramsey. I think he's a cool guy. And I think his information is good for most people out there. But, a lot of that is just basic financial skills, like you just mentioned, like keeping a budget, don't buying stupid things, on credit card rates.
It's it's a certain avatar, right? It's somebody that mismanages money and they should learn the basic 101 of financial literacy.
Yeah. And like I said, going back to your net worth, again, it's not everything and not cattle grading everybody, but hey, let's be honest here. Like in my book, we have this chart where you are in terms of your cash flow and your net worth, and that dictates on what floor you are at in the wealth elevator. So like a lot of people under $100,000 net worth, they don't make $100,000 at their day job, might be in the basement level. Basic personal finance skills. I was kind of fortunate enough, look, I'm not one of these guys who grew up super poor. None of these rage to riches story, right? I'm super fortunate to be able to go to college, get a good job, right? My parents put me on the right track. That said, I didn't start off with, 50 grand to my name, right? I had my own student debt. So I had to kind of work my way up. And I found myself on the first floor of the wealth elevator, where the name of the game is to go buy rental properties to get your net worth up to at least a credit investor status. So for me, from 2009 to 2015, which is a long period of time in my 20s, it wasn't overnight. I bought 11 rental properties that cash flowed for me. And in 2015 was when I transitioned to bigger deals at that point and went into that second floor of the wealth elevator, where you're getting involved into larger projects where you don't have the legal liability that you have to worry about with little rental properties.
Why did you switch over? Like you were doing well, kind of slow and steady with the residential side of things. Why'd you start going into the multifamily? And do you
I mean, life was good, man. I mean, I was working my engineering job. I kind of quit working for the private company I did that was in a very good quality of life.
Okay.
And I, found a cruise job working for the government. And I had these 11 rentals that was bringing in like a few grand of cash flow every single month. But, most of my clients, they need $20,000 of cash flow per month. And this just coming from, 10 rental properties. And of course, I have property management doing all my dirty work for me, right? Yeah. But just to give a sense of people with 10, 11 rental properties, I maybe had an eviction or two every year. Some kind of big catastrophe happened every single quarter, like a tree falling on the house, flood in the basement from a storm, like it becomes a headache. I mean, it's super manageable with 11 properties. Don't get me wrong.
Sure.
But with 30, now you're dealing with an eviction or two every other month.
Yeah.
Big catastrophe happening every 2 weeks. It's just like, this is just a freaking job, right? Yeah. And then I think for me, the big one was if anybody's had 10 evictions, at least one or two of those is going to end up in a big repair bill because these nincompoops just screw your property up for the tune of $10,000 to $30,000. I think was my worst one.
Wow.
And you lose faith in humanity, and you're like, well, sometimes it's bad that you're a numbers person in engineering. You get stuck on these numbers. Like, my goodness, that was like profits for 3 of my freaking rentals for like 2 years, right? You start doing the math.
Yeah.
And you're like, okay, why? I thought I'm trying to make money doing this.
Yeah, why am I doing this again? Yeah.
Yeah, like, whose idea was this?
Yeah.
So, and I get it. Some people are like, well, that's why you don't buy shitty rental properties in bad areas, and you do your tenant screening. Like, well, dude, yeah, these are pretty solid rental properties, right? Like today, you would buy this stuff for 150 grand a unit. These are good B minus areas, decent tenants at the time.
What area?
Birmingham and Atlanta and Indianapolis.
Okay.
And we do all the standard practices with the tenant screening.
Yep.
But come to me when you've had 12 or more evictions and you tell me how it panned out, right?
Yeah.
And unfortunately, this is how people are, right? We're not talking about tenants, like commercial grade tenants that have operating business. We're talking about regular people when things happen, they go through tough times. Like, I mean, when we first started to do apartments, we did a lot of Class C tenants. And like, I can remember one of our best investments out there was 168 units. But even on that one, we had 20% of the people as deadbeats. They just wouldn't pay us ever. Still a strong investment, but like, that's just a lot of headache. And that's just how people are, right?
Wow.
Luckily with apartments, they can't screw up, but there's less surface area literally for them to screw up. So your costs are a lot lower on those bad turnarounds.
Yeah.
But that's...
Can you imagine as well if you bought in blue states and then now they stick around for 6, 12 months?
I don't know, man. I can't even imagine. Not to say anything politically, but like the way I grew up is if you don't pay, you can't stay, bro.
Yeah. Yeah. Just plain and simple, right? It's like common courtesy. Like, yeah. If life happens, I get it. Life happens to everybody. We're all going through something, right? But you can't handle your obligations that you agreed to, then you got to keep it moving.
Yeah. In fact, hey, take this $400 and just don't jack up my property on the way out, bro.
Yeah,
I don't know. That's what's, I mean, after a certain while, like, I think when there's a certain point that I see investors, like when you get to $1 million net worth, or certainly at 2.5 is a threshold, time is more valuable than money.
Yeah.
Somewhere for people. And it is a transition, of course, right? Sometimes it takes a bad life event happening, somebody dying or near-death experience or whatnot.
Yeah.
But like
you realize how precious life is, and the time that we have isn't like, we're not promised tomorrow. So therefore you don't want to waste your time with nincompoops, right?
Yeah. But at the same time, for people who are in the basement level of the wealth elevator and the first floor of the wealth elevator, you guys got to get after it, right? You got to grow your net worth to a substantial number. Then you can make these more first world problem type of proclamations such. But like, I think there's like a stage of this wealth building time, and it's not a get rich quick scheme. That's for sure.
Yeah.
But yeah, that's in a nutshell, like that was, and I think part of it was like, at this point, I was doing everything by myself. Yeah, sure. I was listening to a lot of podcasts, reading a lot of books. I was super smart, but I was just kind of an investor of one. And then I started to interact with more purely passive accredited investors. And a lot of these guys were a little bit older than myself. And they were all kind of dumping their little rental properties for bigger deals. And I was like, all right, I'll follow what this guy does, right? Exactly what I was saying earlier, right? Like, I respect people based on your net worth at the end of the day. I'm going to follow what you say. You're doing this infinite banking thing. Yeah. All right, let me look at this. I'll do it too. Right? Yeah. You know, you buy that Ferrari, maybe I'll buy that too. Yeah. But a lot of those guys don't buy that kind of stuff, right?
Yeah. But success leaves clues, right? And so when you start following those successful people, you know, you can actually set yourself up for a better future for sure. Talk to me about lead generation. How are you guys looking at properties now, and what are you looking to take down on a yearly basis currently? Are you starting to find anything that's panning out?
Yeah. So like in 2020, we started to look at more developing from scratch. Yeah. So there's a lot of folks out there that they think that they can just go buy 100, 300 unit apartment complex. And they're kind of true, right? You get a handful of loan guarantors together. A lot of the banking standards, you technically only need to have like one person who's done it on the team there. So like the barrier to entry is rather low. So this is what we got really frustrated from 2018 to 2021 before we started the development wing, was like, we're just getting bid up all the time from these like new guys getting into this apartment world. So, and I think what you started to see the exposure in the business plan of multifamily value add. So for people who don't understand the whole multifamily value add concept of the cosmetic upgrade, which, you know, you put in 5-10 grand per unit, you change out the flooring, the appliances, paint job, and then you bump the rents up couple hundred bucks, right? All you're trying to do is increase the net operating income by 10 to 20% in 5 years.
Sure.
That in a flat market is enough to, you know, more than double investors' money in that period of time. But what we've seen, and this is why it's such a huge opportunity right now, is that we've seen prices come down at least 20% across the country, some places even 30% plus. So at this point in the market cycle, it's kind of like a no-brainer to get involved. But, you know, that said, for people who went on those hot air balloons last year, a couple of years ago, you're effed. Yeah. And partially of that is like, all right, well, maybe you're able to bum rush all 300 units in 6 months, which is just not possible. You're not possible, right? But even if you could, and you bump the net operating income by 20%, you're still SOL. Your property's still worth less than you bought it for at this point, and your notes do. And this is the exposure that, again, hasn't happened in 40 years and may not happen in any of our lifetime again, or investing lifetime again. But for us, it was like a development, you create so much more value there. Like we started a project, a 200 unit in Huntsville in 2020. We went through the Lumbergeddon where lumber shot up 4 times. Yep. We got through that. We refinanced. So we finished construction around, I think, Q3 of 2022. And that was the time when the interest rates started to creep up. And we were able to...
What did it take from actually like...
Shovel on the ground, like about a year.
About a year? Wow.
Yeah.
That's awesome.
So at that point, we were able to refinance, and there was, because so much value is generated going from like dirt to this huge apartment complex, you're able to refinance even with the market dropping out, right? So, you know, obviously there's risks involved with development, and including like, I mean, that's why you try to go into shovel-ready projects where you don't have to worry about the pre-developing, all that type of stuff. And then you try to manage your costs throughout, guarantee maximum price contracts with the contractor. You know, you can't control lumber prices, right? That's just where you got to kick in more money, right? But execution, I mean, this was kind of the world that I came from as a professional engineer, construction management, right? Doing contracts with consultants, engineers, architects, construction management firms to babysit your contractor, to deal with change order or unforeseen conditions, draw requests, stuff like that. Like this can be done in a very like reliable manner with professionals, but you need money to pay for that. right? So you're not going to be doing this on a little single family home or tract of homes. This is where you need to get to a certain scale. But I think that's kind of what we see. Like, we're just trying to swim upstream, get into projects, because the banks, they're not going to give construction financing for a project like that unless you've done it before. And that was just a way for us to kind of differentiate ourselves from the pack and kind of swim upstream. But every investment has risk, right? Like, this last one was 40-year high interest rates peak, and the market came down 20-30%. We don't know what's going to be next time.
So in the next 3, 6, 12 months, do you think there's going to be more blood in the water? And are you guys going to be going after those bankrupts?
Yeah, we are. I mean, we already know that, man. I could have told you that 2 years ago.
Yeah,
right.
Exactly.
It's just now that the damn balloons are coming down.
Yeah, they're coming down.
But here, I think there's a lot of people out there like putting out the narrative that they're going to go after this distress and blood in the streets. But specifically, I don't think that's our plan to do that. Like, you have to be a certain kind of operator where you like to do those types of heavy distress projects.
Yeah.
Because like when you're picking it up, once it's gone to foreclosure, the operator has no money to fix anything.
Yep.
The dissension in the tenant base is already getting really bad. Things aren't getting fixed. So occupancy, just looking at one metric, occupancy is likely dropping at that point.
Sure.
We've always tried not to buy non-stabilized assets, stabilized meaning 90% occupied or greater. I certainly wouldn't want to jump into anything with 80% occupancy or less.
Yeah.
So I'm not saying that it's a bad business plan. Like, I think if people can do it and that's their jam, that there's amazing opportunities there. But I think I'm just not the type of investor who's going to go in and grab up the blood in the streets. I think that there's a lot of clean assets out there.
Sure.
That if you're picking it up, maybe you don't need to get a 40% discount, but you get it by with enough discount from a couple of years ago, and you put long-term debt on it.
Yep.
And as interest rates start to come down and inflation starts to come back, you're going to get lucky with that. But even if you don't get lucky and you're investing in a flat market, from here on out, you're going to do all right.
Yeah.
That's kind of the way I look at it. So, but maybe that because personally, I just pair that with my more asymmetric plays, like the developments. Like, I'm going to make my big money there.
Yep.
But this other more stabilized apartments, like, are just kind of just churning for cash flow or stability. That's audacious plans.
Yeah, I think you got to ask yourself, how much time, energy, and efforts do I want to put towards something like this to do the heavy lifting? Or, can we do something between the 80 to 90% occupancy and still make a strong return on all these other bets without having to, put in all the gruesome labor that's going to take when you're at, 50% or so forth. So I love that. That's a smart approach. And so you're still going after bigger ground up construction, development that you guys are focusing on now. Is there anything in the future that you guys have coming up that you're looking at and considering to do?
I mean, like, the problem with the development side is, like, we need to get like 15, 20 acres at least.
Yeah.
And that tract of land needs to be not in the middle of nowhere. It needs to be in the path of progress.
Yeah.
So we are very limited.
Sure.
In that. So I could probably count it on less than one hand on how many of those tracts of land we have purchased. And we're just kind of waiting for interest rates to come back down to stick a shovel in the dirt.
Yep.
But I know this is a real estate show, Brandon, and I know, like, look, I'm still gung-ho about real estate. Don't get me wrong, right?
Yeah, talk to me. What else?
I think here's, just to add a counterpoint in here, right? Like, the last dozen years was a great market of, like, free money.
Yeah.
Well, if you look at the Chatham financial curve, they're saying that interest rates might come down to 3%, but no less in long term, right? The free lunch is over. And if you're doing like a SWOT analysis of real estate, one of the big, what do they call it? Tailwinds, the T of SWOT, the tailwinds of real estate was you get great financing, great interest rates. Not necessarily the case, right? If you look at the Chatham financial curve. So we might have lost a big, going back to real estate, like, one of the reasons why we like real estate is it doesn't move very much, right? And the downside of that is because it doesn't move very much, you have to use leverage in real estate. And like I said, prior to this whole changing in the capital markets, leverage is very readily available. Like I could get 75% loan to values. Now that is way down today, maybe even like in the 60s and 50s. They'll come back, but I think we just lost a big trade wind long term. So begs the question, is real estate, a place you want to be? I still think yes, right? Maybe not 100% of your portfolio, maybe still more than 50%. I don't know, right? I think that's where every investor needs to go find a mastermind of other purely passive accredited investors to kind of talk about this stuff. Because I think the problem, you have a lot of people out there, they're like, oh my God, Lane just said real estate sucks. We're never going to do any real estate. It's like, no, that's not what I'm saying, guys.
Yeah.
Don't get me wrong, right? I'm still probably going to have maybe, I don't know, half or 2/3 of my portfolio in this stuff.
Yep.
But, as I talk about in my book, when you get to the third floor, the penthouse level of the wealth elevator, at least, again, this is just me emulating what other high net worth families do out there. You're seeing a lot of these families have private equity, venture capital in their portfolio, non-real estate stuff.
Sure.
And this coming from a guy who just 100% of my portfolio of real estate in my 20s and early 30s, right? So there's a bit of a change, slight change happening.
It's good. I love it. Well, Lane, this was a wealth of knowledge. I appreciate your time today. How can listeners get a hold of you?
Yeah, they can check out my new book on Amazon, The Wealth Elevator. If you shoot me an email and you buy the book, I'll hook you guys up with the audio version, lane@thewealthelevator.com. And if you guys listen to podcasts, check out The Wealth Elevator. Thanks for having me, Brandon. Appreciate it.
Awesome. Appreciate you, man. Guys, you definitely want to reach out to Lane. He is a wealth of knowledge and just an incredible dude doing some big things. So definitely reach out to him. And if you guys want to get a hold of me, you can always do it so on Instagram. It's Brandon Elliott Investments. Otherwise, check out our business page on IG. It is Credit Counsel Elite. Otherwise, if you're looking to learn more about Credit Counsel Elite, what we have going on and how we're helping business owners nationwide be able to get up to $500,000 in new capital with interest rates as low as 0%. That's 2, 3, 4, or even $500,000 in new capital. Interest rates as low as 0%. Then feel free to check out our website, creditcounselelite.com. That's www.creditcounselelite.com, where we have a 10-minute video on there. Explains more in detail what the heck I'm talking about, how it can better serve you. And then afterwards, feel free to book a call with either myself or our team to go over your particular situation, where you're looking to go, and how we could actually help pan that out for you and what that looks like. Otherwise, if you have not already, hit that subscribe button. What are you waiting for? Do that right here, right now, so that you can get the newest notification every single Monday when the new episode drops. Leave that 5-star review afterwards to Ready, Set, Go Real Estate Investing Podcast, and we will catch you on the next one. Till next time, God bless. Lane, appreciate you, brother.
All right. See you, everybody.
See you guys.
This has been another episode of Ready, Set, Go Real Estate Investing Podcast, brought to you by Brandon Elliott. For more information, please visit BrandonElliottInvestments.com. Also, please don't forget to like, share, and leave a comment below. Thanks again for joining. Until next time, God bless.